This is the Value Investor Podcast with Tracey. All things value, all the time.
Welcome back, value investors. So there are a lot of different investing strategies and techniques out there. But what if you could just find a basic strategy that was easy to do month after month, year after year? Sounds great, right? Like that would be the ideal. So what I'm going to talk about today is that kind of strategy, and it doesn't get the love that it should because it's kind of boring, I guess, is why it doesn't get it. But it is a strategy you're all familiar with, and it is dollar cost averaging. Now, what dollar cost averaging is that's when you devote a certain amount each month to buying the stocks. Anyone who's in a 401k through their job probably dollar cost averages right now, and you don't really think about it because this is just how the 401k works, right? So the money comes out of your paycheck every month or twice a month, and it goes directly into the mutual funds or the ETFs. Ben Graham in The Intelligent Investor does look at dollar cost averaging, but it's really only like a page or two in the book. But he cites an older study that was done by Lucille Tomlinson, where she did tests covering 23 10-year purchase periods. The first ended in 1929, and the last one was in 1952, because remember, the book was written in early 1970s. Every test showed a profit either at the close of the 10-year period or within 5 years thereafter. So, Graham liked to comment, like to talk about it because it can work as long as you stay with it consistent, right? But when does it work the best? Obviously, if you're in something like a secular bear market, then you're really taking advantage if you're dollar cost averaging. So think about the years from 2000 to 2013 when stocks, blew up after the dot-com boom, and when it went down 3 years in a row, and then we hit new highs in 2007, and then they sank dramatically in the financial crisis in 2008, 2009. But if you had been dollar cost averaging throughout that whole time period, you would have been buying both at the high in 2007, but a lot more at the lower points. And a lot of people in like 2010, 2011, there were all those articles out there about how, if you had bought the stock market, the S&P 500 in 2000, by 2010, you would have had like no return. It was like flat or something, or up like 1%, or it wasn't that great. But that was just if you bought and held throughout that whole time period. If you had actually just been dollar cost averaging, you would have benefited a lot more because a bear market doesn't really go anywhere ultimately. So you're just adding on the shares at around, consistent prices. So secular bear markets, dollar cost averaging can really work. And I've said in the past that the secular bear market was the best thing to ever happen to the Generation Xers. Yes, their portfolios fell dramatically in the financial crisis and after the dot-com boom to some extent too, but they kept buying. So it was, a boom during their key 30s and 40-year age bracket. And now that we're in a secular bull, those buys from that decade are really soaring. So what else happens in the secular bears, though? Because, people have looked at what happens in that time period too, and the book talks about this to some extent too. So if you had put $12,000 into the S&P 500 at the beginning of September 1929, you would have had, and I don't know why they picked 12,000 here, but for whatever reason, Ben Graham picked 12,000, not 10,000. So 12,000, you would have had $7,223 10 years later in September 1939. So remember, Black Friday and all that stuff happened. Stock market sank, but it did recover into 1930 before it sank again for the next 3 or 4 years. And then there was another recession in the late 1930s that also hit the stock market hard again. So that's why the $12,000 was only $7,223 10 years later. But he gives an example that if you dollar cost average and you started with just $100 and you put $100 in every month, you would have had $15,571. But you would have had to keep doing it during the Great Depression and those multiple years of sell-off, and then the 36, 37 recession when it also sold off. So if you had a super strong stomach or you just put it on autopilot somehow during that really difficult decade, you would have come out with the gains. But that is what happens in secular bears because it turns down and you end up buying more shares. Now, Jason Zweig in his chapter in the book also showed what happened in the dot-com bust. So starting with $3,000 and adding $100 every month from the end of 1999 to 2002, that was the downturn in the market then. The S&P 500 fell 41.3% over that 3-year period. So that was pretty brutal. A lot of people don't remember, but it was. But if you dollar cost average, like I just said, the $100 every month with that starting amount of $3,000, then you would have been down. You still would have been down, but it would have only been 30.2%. So you would have outperformed the S&P 500 by a little over 10%. Which is pretty impressive. So you still would have had pain. Nobody's saying you wouldn't have, but it is you're buying more shares, at those lows. So it's not quite as bad as putting it all in and then just letting it ride. But what about the millennials now? Because Gen X benefited, but they had the benefits of buying in these secular bears. The millennials now are putting in every month into the 401k, but the market continues to make new highs. Is this still a good technique? A lot of people have argued, and I've seen these arguments on Twitter, that no, it's bad. It's bad to dollar cost average now because obviously you're falling behind the more the market rises. But I still argue that I like it even in secular bull markets. And why is that? Because dollar cost averaging takes the emotions out of the equation. And emotions, according to Ben Graham, are the number one mistake most investors make. It causes us to mistime the market. We get afraid or we panic and we pull out, and then we miss the rebound. And so dollar cost averaging can force you to just keep buying when you're scared and to stay in, basically, too. So stocks have gotten volatile again right now due to the tariffs and the trade war. So how many of you are tempted to time it right now? I know many of you are because I've seen you. Oh, I'm sorry. Danny was raising his hand. I thought he was telling me stop, but no. So I've seen you. He's raising his hand because he's answering my question. How many of you are tempted to time it? Yes, he's nodding. Okay, good. So yes, we are all tempted to time it. And I've seen this all over my Twitter feed. I've seen people saying that they're pulling out and going all into gold or just into cash or whatever, but dollar cost averaging doesn't allow you to do that. So if you are an investor and not a trader, so two different things, because the traders do try to time it. But if you're an investor and you're saving for your retirement, your kids' college, a down payment on a house that you might buy, 5 or 10 years from now, something longer term, you're going to be doing it for a while, most likely. So to be focused solely on the volatility right now doesn't really make sense if you're retiring 20 years from now, right? But our minds don't let us think like that normally. So we do panic and we do try to time it. But if the volatility has you spooked, sometimes people will halt their monthly investments. That is possible, even if you are dollar cost averaging. I know a lot of people during the financial crisis, myself included, I was putting into my 401k and it was just basically going away every single month. You'd put in the amount and the market would continue to drop down. And it was like you never even put it in there, right? We all remember this. And so at that point, many of us, myself included, I stopped putting it into the stock market. I was still taking it out of the paycheck, but I did go into cash for a couple of months. That's okay too, even though that is market timing. We shouldn't do it. But this is human nature, right? We can only take like so much pain and so much red and losses. So we've all been there, but dollar cost averaging should still help you to contain your emotions. So keep that in mind. And keep in mind that, we are going to have pullbacks. We just had that big December market sell-off in 2018 in December where there was a lot of fear and panicking. But if you had just stayed with your dollar cost averaging in December, it turns out you would have been okay because that it bottomed out and then rebounded. So you did buy low if you were still just buying your monthly 401k or particular stocks in December sell-off. So keep all that in mind. And I also know that a lot of you have the argument of, I only have $100 to invest every month or the $200 a month or maybe even less. But these small amounts can add up to big numbers, as we've talked about on here, after 10 or 20 years. So don't be intimidated that you can't dollar cost average because you only have this little amount. I mean, I've dollar cost averaged with as low as like $50 before, like every month. And again, it takes a little longer, but it does add up and you are buying on these dips and everything. So keep that in mind too. And another reason why you may like dollar cost averaging is because you're not going to market time, which is a little different than just like having the fear. But a lot of people, they always keep asking me, where will the market go from here? And so again, it's human nature to be like, oh, if it's going to go up, then I'll buy some here. If it's going to go down, maybe I won't. But almost nobody can get that right? Like whenever I get asked this question, my answer is usually always the same. I always say that my magic 8-ball is telling me that it's unclear. Right? I shake that magic 8-ball because no one knows where the market is going. I don't care who they are. You can guess. Some people are better at the guessing, but really no one knows. So, that's why I feel like the dollar cost averaging helps you with the market timing question as well, because you don't really care what it's going to do this week, this month, or maybe even this year if you're just putting it in every month or every couple of weeks or every 2 weeks or maybe even every week. You don't really care. But if you have that multi-year plan and your dollar cost averaging into it, then again, this helps you check your emotions, which we all have, and keeps you on track with that plan, because there's always going to be some kind of big event too. There's always going to be, if it's not Tariff Man tweeting out about the tariff issue, it's going to be Brexit. Remember Brexit? That was in 2016 now. That was when the vote was taken. And yes, we had the huge sell-off on the Brexit vote. And now, does your portfolio notice it now? No, you might not even notice it unless you're obviously over in Europe. It might be more on your mind right now, but even still, there's always going to be these kind of events. So let's turn now to what you can do to dollar cost average. So there's 2 ways to dollar cost average. This is how I look at it. You can do it into individual stocks, where certain of the platforms used to really give you the ability to do it, like the old Share Builder, which, rest in peace, it's no longer with us, unfortunately. It's been bought out a couple times, and then E-Trade finally bought it, and then they basically shut it down. So you can't do it over there. But if you were a Share Builder person, you've discovered that E-Trade and probably the others do it like this too. They do give you the ability to bring cash into your account every month on a certain day. And so you can have the cash in there. Now you have to then trade with it, buy something with it. So, but it does allow you to move the money every month in like a dollar cost averaging kind of way. So you can do it into individual stocks, but you can also do it into ETFs, which is basically what you do in your 401k. You're either doing ETFs or mutual funds, depending on how your plan is set up. So nothing wrong with that, with the indexes. And I've talked about those in the past. But today I want to talk about dollar cost averaging into the individual stocks, because I like this technique, and it allows you to buy on the sell-offs and the corrections without as much fear. And the reason we don't buy on the sell-offs is that we fear it may go even lower, right? But if you set up some kind of automatic buy, or just tell yourself, hey, every, third Tuesday or whatever, I'm just going to go buy this with the money I move into there, then you're going to buy after it dips the 10%. It may fall another 10%. But then the next month, if it's still down, you're going to buy again. And so it takes out a little bit of the, fear if you're getting a sell-off type of stock. Now, if it's going the other way, then it also, you're buying less as it goes up. But so this technique, I do feel, helps you with the stocks that are a little more battered. But I've done it also in the ones that continue to rise with success as well. So keep that in mind. I feel like psychologically, this kind of method is easier for most investor, and you're not as paralyzed waiting for it to bottom. That's kind of a syndrome with a lot of investors, like, oh, it's not low enough yet, so I'm still going to wait. But really, most people cannot time the bottom, not at least perfectly. It's nearly impossible to do. I'm sure, again, there's some traders out there who will write to me and tell me, yes, I can do it, or I can get real close. And that's fantastic for them. But for most long-term investors, you don't really need to pick the complete bottom, especially if you're dollar cost averaging every month kind of thing, because it's all going to kind of even out in the end. And you will still be able to buy pretty low because fear peaks at that bottom, right? So if you're not dollar cost averaging, the fear is going to be really high right there at the bottom. And so you're unlikely to buy at the bottom, actually. Think about December 24th, 2018, the bottom of that correction, right? I was watching it on TV, and, it just kept going down and down and down. So the fear was taking hold there, thinking, oh gosh, after Christmas, it's going to go even lower. It's going to get even worse. So you were unlikely buying on that day, right? But maybe you had a dollar cost averaging buy that just automatically does every 24th of the month or something. Or maybe you had it for the day after Christmas when the market reopened and nobody knew what was going to happen. Maybe you bought right then too, which was basically at the lows as well. So again, dollar cost averaging takes the bottom, that searching for the bottom, out of the equation as well. And also when an industry is in a bear and hated, and we know what those are right now, the retailers, the fertilizers, energy, all of that, it becomes very difficult to dollar cost average. It's the scenario I just gave about the financial crisis where you put money in and then it just kind of disappears. It dissolves. And you're like, dang, I just bought some more shares and it's down again. And that's when most people throw in the towel, and because they think it's going to go on and on like that forever. Even if the fundamentals of the company are good, even if the sell-off seems absurd, you basically can't take the pain anymore, so you just kind of stop. A dollar cost averaging plan, if you can handle that kind of pressure, will allow you to get beyond the fears and you just keep buying. So this is where value investors do have to consult Ben Graham's rules, though, too. You have to trust you're buying a company with sound fundamentals. And because if you're following his rules, those are the only kind of companies you want to own. You are also trying to get it cheap on a PE basis, and you might want to look at companies that pay a dividend while you're dollar cost averaging as well, because if it does continue to go lower and for longer than you anticipated, you at least are getting a dividend, and those dividends are also being reinvested through the dollar cost averaging method, basically. So you might, if it goes lower, might be able to get shares even cheaper through the dividends being reinvested as well. So let's take a look at some stocks that I've just randomly picked that have basically gone south in the last year. I picked ones I knew were down on their luck a bit because, again, those are kind of easier to dollar cost average than the ones that are on the rise, although I have dollar cost averaged those. Like, for instance, recently I've been dollar cost averaging into Lululemon, the retailer, because I like it a lot, and it's going up. So that hasn't been real helpful to me to dollar cost average into it, but I still am doing that because I'm trying to think longer term with my investing with that one. But some of these other ones, if they've had the reverse, if they're on the lower side, and seeing the downward trend, then dollar cost averaging makes a little bit more sense. And it's a little bit easier to do psychologically because we're buying more shares on the cheap, right? So I took a look at these 5 stocks, and almost all of them do have the dividend, which is what Ben Graham says to look out for. One of them does not, but I picked it because it's popular and it's been down pretty sharply over the last year. So it hasn't been a bad stock to dollar cost average. And so let's start with that one off the get-go here. And that one is Square. Ticker is SQ. And it does have a PE of 80 right now, which is its lowest PE since it actually has earnings. So that's over the last 2 years. It has had a PE because it now has earnings. And so this is the lowest it's been, but these shares are down 23% over the last year now. And they basically have been going nowhere over that whole time period. So, they're in this like kind of narrow range, but they're down versus a year ago by the 23%. So it's not a bad kind of chart to just dollar cost average every month or whatever your dollar cost average kind of schedule is. And so it does not pay the dividend though. So something like this, you definitely, for growth stocks, it's a little bit more difficult if they don't pay the dividend to do the dollar cost averaging in your own mind, especially if they dip lower because you're not getting anything for your patience. But something like Square is one, if you look at the chart, that is favorable to the person dollar cost averaging. Okay, then let's switch on to a couple others that all do pay dividends. So if it gets worse, we get something for our patients with these. So I picked out a couple of banks actually, because the banks have been really battered here. And a lot of them are paying pretty juicy dividends at this point. So the first bank is KeyCorp, and the ticker is KEY. This is trading with a PE of just 8.8 now. So a lot of these banks are dirt cheap on the PE level. Not sure that if those earnings aren't going to come down, though, if these yields continue to decline here, it's going to get a little bit shakier for the banks in terms of earnings growth. They probably won't be growing earnings much, but you do get this dividend to thank you for your patience during these kind of more difficult times. And this one is yielding 4.7%. So that's pretty juicy there. Over the last year, these shares are down 24% now. And they are up off their December lows, but they've been mostly treading water here throughout 2019. And I wouldn't be surprised to see some of these start to, maybe take out those December lows. Including the next one that I'm going to talk about, which is Comerica. That's CMA is the ticker. They are a big regional bank with most of their business in like Texas and Michigan, actually. I like them because they're in Texas and that economy is still doing really well. But 1 year, these shares are now down 39%. And they're really cheap. PE is just 7.4 here. And they are now trading lower than their December 2018 bottom. So people are fleeing pretty badly out of some of these regional banks. That dividend yield 4.6%. So right up there with KeyCorp to try to give you something for your pain here. But if you're dollar cost averaging on this, you are buying more as this stock sinks. Keep that in mind. That's why we like it, right? Okay, so those are two of the banks. There are a lot of other ones you could be looking at right here, but I only looked at these two regional banks for now. So, but again, I should do a whole episode, I think, on maybe the banks going forward here towards the end of the year because they are definitely cheap. Now let's switch to transports. Delta, I think I've mentioned them on the show in the past. DAL is the ticker. They're not down as much over the last year. They're down only 2.9%. So not as big, but they did see a big sell-off in December 2018. So if you've been dollar cost averaging, you would have gotten them a lot cheaper then. They have rebounded, but they're kind of in this like narrow trading range too, like the overall market, frankly. They pay a dividend yielding 2.9%. That's pretty good. And so you are getting paid for your patience with what's going on here as well. So I like that a lot. As well. And Delta does not have any exposure to the 737 MAX. I think I've mentioned that in the past. That's why I like them, because they have not had to cancel any of their routes or have anything, problems with capacity or that kind of thing, because they don't fly it. So keep that in mind when you're looking at the airline stocks. And then we're going to wrap up with the perennial favorite of value investors that pays a dividend at least, and that is Apple. AAPL is their ticker, and year to date, they're down 6.7% now. They're well off those December lows, but if you had been dollar cost averaging them, you would have gotten some shares at those really low December lows, and you would still be getting them under what you would have a year ago, obviously, since they're down 6.7. And so that's the way to do it if you're dollar cost averaging. The PE isn't quite as low on this one, and it's not as low as we've seen it in the past. It's at 17.5 right now. That's the forward PE. Those earnings are coming down a bit, and it has a little bit of the value trap scenario going on there. So, but dollar cost averaging will, if these shares retreat further, you're going to be buying more as they retreat, and maybe that PE comes down a bit then. The dividend is yielding 1.5%, so that's the lowest out of these 4 dividend payers that I talk about here, because Square doesn't pay anything. But you're still getting something for your patience with them, and that's why the street and a lot of investors like Apple on the technology side, because it's a little bit harder to find the tech companies that pay that nice dividend yield. But Apple is one of them. So those are the 5 stocks I just kind of took a quick look at for dollar cost averaging. There's plenty of other ones, like I just mentioned, in the areas that have really taken a battering here in 2019, which is retail. Like the fertilizers, I've said, are not looking too good. The energy stocks also, but it's been real hard to be dollar cost averaging in a lot of those areas because it just continues to decline here. So, but I like the method, and you should consider it if you are trying to take the emotions out of your investing and you want to just set up something that is a little bit easier, and it just does it on the designated day every month, and you can kind of just let it do its own thing without the panic, I guess is the way. Except the panic is still out there, the fear is still, but hopefully it will mute some of it. So let's go over those stocks again. There was Square, which is SQ. We had KeyCore, which is KEY. Comerica is CMA. Then we had, what was the other one? Oh, Delta. How could I forget them? DAL. And then we had Apple. AAPL is the ticker there. So be sure to subscribe to the Value Investor Podcast, because I continue to go over tips from Ben Graham, from The Intelligent Investor, and what value investors should be looking at and trying to stay sane in this kind of volatile market here. So I think the book is excellent. You should all try to read it. But if you don't have time, tune into these episodes at least to get some tips, because I've been going over all of them, and it's really helped me as an investor already just to read. And I'm only in, I think, 5 or 6 chapters now, I think it is. So still ways to go, and I'm hoping to get a lot more insight that'll help me be a better investor, and I hope it's helping you. So be sure to subscribe. We are on Spotify under the Value Investor Podcast. We're on Apple under Value Investor Podcast, and you can also get 2 shows for one on SoundCloud under the Zacks Market Edge over there. But be sure to get us somewhere, and I'll be back again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.